Hi, my name is Wilton and I'm a product manager at Fintel. Today I'm going to talk to you about insider trading. In this presentation, which is 20 slides, we will cover the definition of insider trading. We will have a small talk about corporate insiders. I will introduce to you the insider trading anomaly, and then I will describe to you some techniques you can use to exploit the trading anomaly in order to make better trades. The SEC has a very specific definition of insider trading. Basically, the SEC says that illegal insider trading comes about when somebody with material, non-public information makes a trade on that information. The SEC does not state that they have to make a profit. All they state is that a person must be in possession of material, non-public information, and then on the basis of that material, non-public information, they make a trade. Another important point here is that this is illegal insider trading. And the fact that they specify illegal suggests that there is legal insider trading. And we're going to talk a little bit more about that later. Now I'm going to share with you some examples of illegal behavior. In our first example, which I will admit is contrived, an employee of a company discovers that the company will beat earnings expectations before it is announced and then trades on that material non-public information. This is probably the most common scenario most people think of, which is somebody who works for a publicly traded company discovers some kind of information and then wonders whether or not it would be illegal for them to trade on it. And as you can see here, it would be. In our next example, an employee at a printing company learns of an acquisition when preparing offering documents for the law firm handling the transaction. This was actually a real case, and the circumstances around it was a proofreader who worked at a printing company that printed tender offers for a law firm discovered that about acquisitions and then traded on that information. The notable point here, I believe, is that the proofreader was not an employee of either company party to the transaction, was not an employee of the law firm, but thrice removed an employee of a service provider. And despite that, the SEC took action against that person, and they were charged and found guilty and fined. However, I want to go back to the previous point. The SEC defined illegal insider trading, which suggests that there is legal insider trading. In general, it is not illegal for employees of a company to trade in their own shares as long as they are not using material non-public information as the basis for those trades. So, for example, if an employee of a company that's in the biotech space or in some specific industry feels like the company is going to do better in the coming years or months, does not have material non-public information such as earnings or financial information, and buys shares of their company, that would not be considered illegal insider trading. Now I'm going to talk to you about corporate insiders. Corporate insiders, and this is kind of my term, the SEC uses just the term insider, but I want to clarify and make sure that we don't conflate this definition with the prior definitions that we've been talking about of insiders. A corporate insider is an officer, a board member, or a shareholder that owns 10% or more of a publicly traded company. Now, as we stated earlier, it is not illegal for employees of a company to trade in their own shares as long as it's not based on material non-public information. The problem is that officers, board members, and 10% shareholders of publicly traded companies tend to have a lot of access to material non-public information. So in order to ensure that the law is not being broken, all of these corporate insiders are required to publicly disclose their trades to the SEC, and those trades essentially undergo a high degree of scrutiny by the SEC in order to make sure that nothing is being done illegally. And so what you find, if you go back and you look at all of these trades that are made by corporate insiders, you find that they tend to do, as a whole, better than the average Joe. Let's put it that way. And that takes us to the concept of the insider trading anomaly. A lot of research has been done on insider trades, And this is just one example of a research paper here. And basically what it states is that A, corporate insiders earn abnormal returns. That means that they tend to do better than the stock market when they're trading their own shares. And two, outsiders can also earn abnormal returns when basing their trades on those publicly filed documents that the corporate insiders are required to file. Okay, so let's talk about reporting requirements for corporate insiders. As I said, because corporate insiders have ongoing access to material non-public information, all of their trades are reported to the SEC. This is a Form 4, which is the standard reporting form that corporate insiders must file within, I believe it's 2 days of making a trade in a company in which they're an insider. Now there's a lot of information here to unpack, so I've highlighted the most relevant information for us. In these red boxes you can see, first of all, the insider's name, second of all, the name of the company and the ticker that they're reporting for, of which they're an insider of, and then the final red box, you can see the transaction date, you can see the transaction code. In this case, an M is an exercise of stock options and an S is a sale of stock options. So what you see here is this person exercised stock options and sold them pretty much, the same day. They exercised 37,500. The A means they acquired those shares at the price of $261. That would have been the strike price of their options. And then it shows the amount of shares owned after the transaction. And then they immediately sold 75,000 shares at a price of $51.41, leaving them with 827,100 shares. So again, there's a lot to unpack here, and going through the SEC system to find all this information would be quite painful, actually. So Fintel provides a means for looking at this information in a more compact format. Here you can see at the top of this table here, those same two transactions that we just saw on that form listed. An exercise of a stock option right here, and a sale. And you can see that the share price was $261 for the exercise, $51.41. All of the relevant information from the Form 4 is listed here on this table. In addition, you can see that this transaction is listed as part of a 10b5-1 transaction. So what is a 10b5-1 transaction? The SEC recognized that the problem with corporate insiders is that they have the inside information, and yet they still want to be able to make trades. And so how can you provide them with some type of process for making these trades and selling shares without being accused of insider trading? So a 10b5-1 is a trading plan. It's written down, it specifies the number of shares that the person is going to sell or buy on an ongoing basis. This trading plan is given to somebody, like their broker, and that plan is executed, religiously or accurately, throughout the coming years. And this is basically a defense for the insider to say, look, I wanted to be able to make these trades, but I don't want to be accused of insider trading, so I've set this up. I've set up this trading plan, and I've stuck to it. The important takeaway here is that once the plan is in place, then the trades can be made even if the insider has material non-public information at the time that the trade is placed. Because the assumption is that this plan was put in place a while ago, but the material non-public information might have only come up recently, and it allows them to have an active defense against these accusations. And the other thing is that the other takeaway from this is that if somebody makes a trade that's based on a 10b5-1 plan, then it probably does not have a lot of signal for us. It probably is not very meaningful. It's probably not very predictive of the future stock movements. Okay, so earlier in this presentation, I introduced the insider trading anomaly. And just to review, what it stated is that corporate insiders, tend to do better than market returns. They have excess returns when trading shares of their own companies. What I'm going to do now is introduce to you a feature that Fintel offers that helps you evaluate insider trades in order for you to be able to understand and assess the future likelihood of an increase in price or decrease in price. Okay, so I'm going to walk you through this here. This is a chart that's available on Fintel that shows the performance of AMD shares following a purchase transaction by Lisa Su in 2012. And the idea here is that we want to be able to track and see how well this trade has done over time, and then in future slides you'll see how you can apply this on a broader scope. But let me unpack this chart for you here first. It's one trade. It was a purchase on 2012-11-07, so November 7th, 2012. And if you follow the arrow, you can see that that is the starting point of this chart. The bottom axis is the duration, or is the time frame since that trade. Okay, so you can see that it was January 2013 up through January 2020. So it was a long time period here. The vertical axis is the percent gain or loss, or the cumulative percent gain or loss. Okay, so if you track this chart, or this line from the zero spot, which is the date of the purchase, through the current period, you will see that the total cumulative return for this particular trade, had she held on to it, was 450%. Now I'm going to show you a second chart. This is very similar to the prior one, except that it shows two trades. We start with a trade on November 21st, 2018. You can see that it started with 0% gain loss, and over the year, looks like it's about a year and a half maybe, the total performance of that trade, it was a purchase, the share price rose 150% after that trade. You can see a second trade was made on 5/30/2019. This is the red line, and the share price went from whatever it was up 60% in the time subsequent to that trade. So I'm hoping you're getting the idea here. The idea is that you can simply plot the post-trade performance of insiders and try to get a sense about whether or not they're doing well or they're doing poorly. In these two cases, we can see that there were purchases made, and the share price went up significantly after that, and so you could conclude that these three trades that we're looking at were all quite successful. Now let's take a look at another slide. This is a more complicated chart, but I'm going to walk you through this one as well. This shows you the performance of Rory Read's historical DELL purchases. Historical DELL sales over the last few years. Now, I want to make sure that you understand that there's nothing that I'm trying to say here that would imply that anything here is illegal, right? We talked about the illegality and legalities of insider trades, corporate insiders, and there's nothing here to suggest, and I'm certainly not suggesting that anything that anybody has done here is illegal. So that said, let's take a look at what this chart shows you. It looks like there were 4 trades done right around the same time in July of 2019, July 12th, July 15th, July 17th, and July 18th. That would be the first 4 lines at the top left, a green, a red, a purple, and a blue. And you can see that in the following months, there was a precipitous decline, followed by a sharp uptick again, and then down and then up. This is basically charting the performance of DELL stock in the weeks and months subsequent to those sale transactions. You can see that there was a pretty significant 20% decline directly after Rory Read made those sale transactions. And subsequently, you can see to that there were 1, 2, 3, 4, maybe 3 trades made on December 31st of 2019. This is kind of to the far right, and then a couple more made in January 14th. And both of these, and these two kind of blocks of trades also have declined a bit, although not quite as significantly. And so the point here is that there seems to be some real kind of signal, or there seems to be some type of predictive value in looking at these trades. And you might come to the conclusion, or you might not, that if Rory Read makes a sale, sells some DELL shares in the future, then you might think about how this chart is played out, and it might inform you as to whether or not that trade might have a significant impact on the share price, or it might be a significant predictor of the DELL share price going forward. Okay, so if you want to find these charts yourself, it's real simple. In the top left of every page on Fintel, there's a search box. You can search either for the insider directly, or if you prefer, you can search via the ticker. The example I'm giving you here is searching by ticker. So type in the ticker TSLA if you want to look for Tesla, and click on the search button. And in the search results, you'll see the second graphic there. You can see Tesla Motors is one of the search results. If you click on that link, the Tesla Motors link, it will take you to this third screenshot here, and you can see how I've selected the tab Insiders, and on that tab shows you all of the insiders available for Tesla. And you can click on Elon Musk and see what his trade performance is. Thanks so much for your time. If you enjoyed it and you want me to make more, please like this video and then subscribe to our channel.